Hello guys, welcome back to another Lumby trading video. In this one we're going to be doing some stock analysis on DKNG, which is DraftKings. And the main reason doing analysis on this is it has come into a low risk buying zone, but has shown a pattern that I kind of want to make sure you guys are always paying attention to if you're watching standard deviation videos quite a lot. So as always, we'll go through the normal analysis. So firstly we'll go into a daily chart, a plain daily chart, to see is there any gaps that need to be filled, and if there is, where are they. So the first one that stands out is a gap fill between 38.25 and 37 is at 50. So this is a potential area that we can see get down to, or get pushed down to fill that gap. And it looks like any other gap has somewhat been filled. You can look at these gaps where obviously this is still a gap that needs to be filled. However, these ones I never pay as much attention to because they're not as obvious to all traders, so the reaction you get in these zones don't tend to be as harsh. So obviously with this one it is a gap because it has got down, but the next candle is still kind of in a relatively close zone to the previous candle. So a lot of people looking at this at a glance may not notice that gap, and it's why I tend to stay away from them. However, the gap we have down in the bottom left, you can see it's gapped up. The candle is nowhere near to touching it the next day. So even if you're just skimming the chart, and you would have seen when we were plotting the support and resistance, so that one stood out to us right away. So that's a big thing to be looking out for. Ones where they're not touching are the key ones we'd be looking for. For the main reason being, they stand out to more traders, tend to have bigger reaction zones. So that is a level we'll be looking out for. Apart from that, there's no other key levels that really stand out to me. So then I go over to the next chart, do some standard deviations and see, okay, where are low risk buy zones and where we'd be looking to lock in profits. And first I want to go over the pattern that you want to be looking out for when taking these trades. So if we zoom in, you would have seen that back on the 30th of September, it hit our deviation of around $48 and has since then did a small bounce off. You may be looking at this saying, okay, how would we have made profit off this? Because depending where our stop was, this might not have even been a 1-to-1, and doesn't look like it's bounced all that heavily, and you're not wrong. So how do we find a profit taking area, or at least see if it's going to fail to continue down? And the thing we usually look for is where is the next closest deviation, and it doesn't mean it has to be on the daily. So for example, it never hit the mid or half deviation on the daily. However, if you go over to the 4 hour, you'll see it bounced off this $48 level and hit straight into a statistical mean at $50 before and kind of bouncing between this area. So that's the thing you want to be looking for, because you noticed it came in to touch this deviation and kind of failed straight back down. This doesn't mean that it's not going to bounce, because then you wait for it to kind of retest this level, which you can kind of see has happened, retest, and it failed again. So when you see this, it is something I would be a bit hesitant of, and if I was in with some size now, it's probably a time I would kind of cut out some of my size. It would either be break even or most likely a bit of profit if you were to get out now. And the reason I say I would get out is because it doesn't show a strong bounce. So it doesn't mean there won't be one, but usually we look for a strong amount of buying pressure to come in, because if there's not, it usually means you get the bounce, or you at least get that small bounce, and then it continues lower. So that's the kind of the thing we would be looking at for right now on DraftKings, is actually a push lower. It looks more bearish to us. So to me, that shows that the next good buying opportunity would be around $43, or to be more precise, $42.90. So kind of that key level, yeah, 43 will be that new key buying opportunity. And again, we'd be looking for the same thing when it comes into this 42.90 and we're looking to get long. How are we going to see if this move's going to fail? We would look, what is the next closest deviation? Doesn't have to be a full deviation, could even be a half deviation. And in this case, on the 4 hour, the closest one you then got is 46.40. However, if we go onto the daily chart, we can see we got a deviation at 44.50. So when we get come down to this $42.90 slash kind of $43, we'd wait for that bounce up to $44.50, and if we fail off that level, then it most likely would indicate again that we would continue down lower. So that's kind of the key thing you want to be looking out for on these half deviations, because, or even full deviations, is that's usually a good indication on how much buying pressure comes in. And even in this case, let's say you take off your whole position now, you get out with a small amount of profit or break even. So yeah, that wouldn't really matter. You haven't taken a loss on that trade, and even then, if it does continue out, who cares? You get another trading opportunity. But this one, just you're kind of taking unnecessary risk. There will always be stocks coming into these buy zones, so why take it on one that doesn't show as much chance of being successful? So that's always a key thing I'd be looking out for. And on DraftKings, it doesn't show to be that successful, at least at this level. Would have provided the good day trade. So depending how you trade them, if you intraday trade, then obviously you would have most likely made that trade from $48 to $50 and would have been a great day trade. But on the swing side, doesn't look as strong. So yeah, basically we'll be looking for that push down further to $43. We want confirmation that it's going to continue up at that $44.50. If we can close above that, then it's a good indication that we will get that strong bounce from there on, and maybe even a reversal. Otherwise, if it comes in and kind of fails off that $44.50, then we would expect it to go down to the next deviation, and in that case that would be $40.80 kind of slash $41. So yeah, sorry I kind of explained that in a long way, but I think it makes sense. So you also know in future analysis videos on what we're looking for at these deviations, because yes, you can kind of blindly say we can buy at that level, it's low risk, and yes, that is true, but you want some kind of strategy or some kind of extra information just to make the action a bit stronger, and kind of getting rid of unnecessary risk. Because what is the point of taking unnecessary risk? Because more risk doesn't always mean more reward, and in a case like this strategy, more risk doesn't mean more reward. It's just unnecessary risk. So yeah, basically what we'd be looking for is a breakdown before buying at around $43. And onto the upside, if it does instead of breaking down and does continue upwards, it's just that the buying pressure is delayed, then we would be looking to lock in profits if you're long, and or get short at the next deviation, so 56.85, 62.90 and 63.90. Those would be kind of our key levels for the time being, and yeah, the main things we would be looking out for. Obviously, it could always go to a more extreme level, so in this case, you know, $71, $78, 84, and at any of these levels, we trade them the same way as we would any other level. So, I mean, by now you should probably know how to trade these levels if you trade them a bit like how I do. So those levels are on the screen. But if you are short and you're waiting for that push lower, and obviously it would always make sense to be locking in profits at these deviations, but where it's kind of where, if I was short, I would be completely out of it. And the area I would say I would be completely out of a short position would be $38 or $37.50. The reason for that is that a gap fill. When a gap is filled, 9 times out of 10, you'll usually see a bounce from then on. It doesn't tend to continue because it usually just tries to fill that gap, and then it says, okay, I can continue up. So that's the main thing to be looking out for. And if you go onto any other chart, you'll probably see that. Let's just go onto maybe Facebook, for example, see if we have an example of that where we have a clear gap fill, and then see what happens. So here, gap fill obviously comes back, fills the gap, continues up, fills the gap, continues up, and then you'll probably see this. Obviously, Facebook's been putting back more lately on obviously their service going down and then the whistleblower, but over time we will most likely see this break to an all-time high, and that be looking at those key things when it comes into the gap fills. We don't really actually have any now. I guess we have a gap fill at this. Actually, we don't anymore. It's been filled. But again, you'll see the same thing. Gaps get filled. We had gaps here. Comes back, gets filled. Exactly. Continues down. Create a new gap here. Test it. Retests and fails. So that's usually what you want to see, because when it retests the gap, it tends to continue in that direction, or reverse it. So like obviously in this case, you fill that gap and then it goes in the other direction. That's usually what you see, because to a lot of investors and or traders, when the gap's filled, they're saying, okay, the price is now kind of stabled out a bit, it makes sense that the stock should continue down, so we'll short it. And on DKNG, which is the stock we're obviously analysing in this case, people are waiting for it to come back and fill this gap, because it only makes sense. Usually around like 90-95% of all gaps are filled, so a lot of investors will be waiting, okay, we want this gap to fill before we're happy to get long again. So that's always a key thing to be looking out for. If you have a gap that hasn't been filled, usually if it's not been filled within the year, then you tend to ignore it, for the main reason being not anywhere near as many investors will be looking at it. Most people use a 4-hour 180 day, most people use a daily 1 year chart. Longer than that, not as many people use. Obviously you can use a max term time frame, you can use a 3-year time frame. Yes, they may have gaps. DKNG maybe not, because it hasn't been around for as long, but if we do go back to it, Facebook just for the example, any gaps that you do have that are not filled within the year are usually just best to avoid, because they're nowhere near as likely to get filled, and even if they do, they don't tend to have as strong as a reaction. So hope that video was insightful, hope to see you in the next one, and that's it. Peace.